Silver just hit $76 an ounce. Not a drill, not a glitch, not speculation, $76. That's a 48% surge in less than 72 hours. The physical market is in chaos. Dealers are pulling inventory. Premiums are exploding. Retail buyers are locked out. Industrial users are scrambling. And at the center of this storm sits China. Beijing just rolled out new export restrictions on refined silver. No warning, no grace period. Immediate enforcement. And the global market is reacting like a cornered animal. You need to understand what's happening right now. This isn't just a price spike. This is a structural fracture in the global silver supply chain. China controls 37% of global refined silver production. They process raw ore from mines around the world. They refine it, they export it, and now they've turned off the tap. The new rules require government approval for every kilogram of refined silver leaving Chinese borders. Applications take weeks. Approvals are rare, and the clock is ticking for every industrial manufacturer, every mint, every defense contractor who depends on Chinese silver to function. The panic isn't theoretical, it's live. Right now, premiums on American Silver Eagles are trading at $14 over spot. That's unheard of. In London, the LBMA is reporting delivery delays stretching into Q2. Zurich vaults are seeing inflows spike as wealthy buyers pull metal out of ETFs and into allocated storage. Mumbai dealers are rationing 1-ounce coins. Perth Mint suspended retail orders yesterday. The physical shortage is accelerating faster than the price can keep up. And here's what they're not telling you on CNBC. This wasn't a surprise. China telegraphed this move 6 months ago when they added silver to their critical minerals list. The same list that includes rare earths, gallium, germanium, the same list they've weaponized before. They did it with graphite last year. They did it with rare earths in 2010. And now they're doing it with silver, because silver isn't just money. It's a strategic industrial metal embedded in every solar panel, every missile guidance system, every electric vehicle, every 5G antenna. And China knows it. The timing is deliberate. Silver inventories were already at 15-year lows before this announcement. COMEX registered silver, the physical metal available for delivery, sits at just 41 million ounces. That's enough to cover about 6 days of global industrial demand. 6 days. And now the largest refining hub on the planet just went offline for export. The math doesn't work, the supply doesn't exist, and the market is starting to realize it. Let's talk about what happens next. Industrial users are the first to break. Solar manufacturers in Germany, electronics producers in Japan, defense contractors in the US. They can't wait weeks for Chinese export approval. They need silver now. So they're bidding up spot prices, they're paying premiums, they're rating COMEX, and that's creating a feedback loop. As industrial buyers pull physical metal out of exchanges, available inventory drops. As inventory drops, tightness increases. As tightness increases, premiums explode. And as premiums explode, retail investors panic buy, making the shortage worse. This is a liquidity crisis in slow motion. The paper market, the futures, the ETFs, the unallocated accounts, still pretends there's plenty of silver. But the physical market knows better. Spreads are blowing out. Basis is spiking. Backwardation is appearing in far-month contracts. These are all technical signals that scream one thing. The paper market is diverging from physical reality. And when that divergence gets big enough, the paper market breaks. Here's the part that should terrify you. The COMEX has 200 million ounces of paper claims on just 41 million ounces of registered physical silver. That's a leverage ratio of 5-to-1. In a normal market, that's fine. Most contract holders don't take delivery. They roll or cash settle. But this isn't a normal market. If even 10% of paper holders demand physical delivery, the exchange defaults. And if the COMEX defaults, the entire global pricing mechanism for silver collapses. We're talking about a systemic event, a repricing event, a moment when the market realizes the emperor has no clothes. And China knows this. They're watching. They're waiting. They were holding the largest silver reserves in the world, and they just made them more valuable overnight by restricting everyone else access. This is economic warfare dressed up as environmental regulation. Beijing claims the new export rules are about controlling pollution and strategic resource management. But the real goal is leverage. Leverage over the West's green energy transition. Leverage over defense supply chains. Leverage over monetary alternatives to the dollar. Because silver is all of those things. Let's zoom out. Why now? Why silver? Why China? The answer is bigger than one metal. We're in the early innings of a global resource war. The US and Europe want to transition to renewable energy. That requires massive amounts of silver. China controls the supply chain. If the West wants to go green, they have to go through Beijing. And Beijing just reminded them of that fact. This is the same playbook they used with rare earths a decade ago. Cut exports. Watch prices explode. Force foreign companies to build factories in China if they want access. It worked then. It's working now. But there's another layer. Silver is monetary metal. It's been money for 5,000 years. And in a world where central banks are printing trillions, where the dollar's dominance is being challenged, where BRICS nations are talking about commodity-backed currencies, silver matters a lot. China isn't just securing industrial supply chains, they're cornering a monetary asset, and they're doing it while the West is asleep at the wheel. Let's get specific about who's bleeding right now. Solar panel manufacturers are in crisis mode. Silver paste is a non-negotiable component of photovoltaic cells. You can't build a solar panel without it. And 70% of global solar production happens in China or depends on Chinese refined silver. European and American solar companies are facing an impossible choice: pay ransom-level premiums for spot silver or shut down production lines. Some are already choosing the latter. First Solar, one of the largest U.S. solar manufacturers, just issued a quiet supply chain warning to investors. Canadian Solar delayed a new factory opening in Texas. LONGi Green Energy in China, ironically insulated from the export ban, is ramping up production to capture market share while Western competitors starve. This is industrial policy masquerading as supply shock, and it's working exactly as Beijing planned. The electronics sector is next. Silver is the most conductive metal on Earth. It's in every smartphone, every laptop, every EV charging port, every data center server. Apple uses silver in Lightning connectors. Samsung uses it in OLED screens. Tesla uses it in battery contactors. And all of them source refined silver from the same global pool that China just restricted. Lead times are stretching, costs are spiking, and margins are compressing. Tech stocks might look fine today, but the supply chain stress is building beneath the surface. Then there's defense. This is where it gets serious. Silver is critical to military applications, missile guidance systems, radar, night vision, electromagnetic warfare tech, sonar. The U.S. Department of Defense doesn't advertise how much silver it consumes, but estimates put it in the millions of ounces annually. And a significant portion of that refined silver has historically come from China or Chinese-owned refineries. Now that pipeline is compromised, the Pentagon is scrambling to secure alternative sources, but there aren't many. Mexico, Peru, and Poland are the only other major refining hubs, and they're already sold out for the next 6 months. Here's the hidden danger. The U.S. military-industrial complex has been operating on just-in-time inventory systems for decades. Efficiency over redundancy, lean supply chains, no stockpiles. That worked fine in peacetime, but we're not in peacetime anymore. Tensions with China are the highest they've been since the Cold War. Taiwan is a flashpoint, the South China Sea is militarized, and now the U.S. defense sector is realizing it's dependent on a strategic rival for a critical war material. That's not a supply chain risk, that's a national security catastrophe. And it's not just the US NATO allies are in the same boat. The UK, France, Germany, they all rely on imported refined silver for defense manufacturing. The European Union has no significant domestic silver refining capacity. Zero. They outsourced it decades ago in the name of cost savings. Now they're paying the price. Brussels is in emergency talks to secure silver supplies from Peru and Poland, but those countries are prioritizing their own industrial needs first. The global silver market has become a zero-sum game, and Europe is losing. Let's talk about price discovery. $76 an ounce sounds high, but it's not high enough, not yet, because the current price is still being set by the paper market, futures contracts, ETFs, unallocated accounts, digital claims on physical metal that may or may not exist. But the physical market is pricing silver much higher. Right now, if you want to buy a 1,000-ounce silver bar for immediate delivery, you're paying $85 to $90 an ounce in some markets. That's the real price. That's the price of scarcity, and that's the price the paper market will eventually have to acknowledge. The divergence is widening every day. In London, the spread between spot and physical delivery is now $8. In Zurich, it's 10. In Singapore, it's 12. These are unprecedented dislocations, and they're telling you something critical. The market is breaking. The price you see on Bloomberg or Kitco is a fiction. It's a number derived from contracts that can be settled in cash. But cash isn't silver, and when buyers demand metal, the fiction falls apart. Here's what happens when the fiction collapses. First, premiums explode. We're already seeing that. Second, delivery delays stretch from weeks to months. We're seeing that too. Third, major institutions start defaulting on delivery obligations. We haven't seen that yet, but we will, because the math doesn't work. There are more claims on silver than there is silver. And when claimants demand physical settlement, someone gets left holding an empty bag. That someone is going to be a bank, a brokerage, or an ETF. And when it happens, confidence in the entire paper market evaporates. This is why China's move is so dangerous. They didn't just restrict supply, they lit the fuse on a financial time bomb. Every day that Chinese silver stays locked behind export restrictions, the pressure builds. Every day, more industrial users scramble for metal. Every day, more investors realize the paper market is overextended. And every day, we get closer to the moment when the system breaks. Now let's talk about who's prepared and who's not. The big miners are sitting pretty. Newmont, First Majestic, Pan American Silver, they produce physical metal. Their revenue is spiking. Their stock prices are soaring. But the refiners who depend on Chinese feedstock are in trouble. The mints who buy refined silver from China are in trouble. The ETFs that promise physical backing but lease metal from bullion banks are in trouble. And the bullion banks themselves, the ones running fractional reserve silver operations, are in deep, deep trouble. Because here's the dirty secret of the silver market. The bullion banks don't hold all the metal they claim to. They operate on leverage. They lease metal from central banks and sell it multiple times over through unallocated accounts. It's profitable as long as no one demands delivery. But when everyone demands delivery at once, the scheme collapses. And that's exactly what's starting to happen. Allocated accounts are seeing inflows spike. Unallocated accounts are being drained. And the bullion banks are scrambling to source physical metal to cover their obligations. They're failing. And the market is starting to notice. Let's step back and ask the bigger question. Why does China care so much about silver? Yes, it's industrial. Yes, it's strategic. But there's a third reason. Silver is money, and China is positioning itself for a post-dollar world. Here's what most analysts miss. The BRICS nations, Brazil, Russia, India, China, South Africa, have been quietly accumulating physical commodities for years. Gold, silver, oil, rare earths. They're building a parallel financial system, one that doesn't depend on the US dollar, one that's backed by tangible assets instead of debt. And silver is a cornerstone of that system. Because silver is the people's gold. It's affordable, it's divisible, it's recognizable, and it's been used as money for millennia. China holds the largest government silver stockpile in the world. Estimates range from 300 million to 1 billion ounces. They've been accumulating for decades through state-owned mining companies, refinery operations, and quiet purchases in the physical market. They don't report these holdings. They don't announce them, but the metal is there. And now they've made it scarce for everyone else. This is preparation for a monetary reset. The dollar is dying. U.S. national debt just crossed $36 trillion. The Fed is trapped between inflation and recession. Foreign central banks are dumping treasuries. The petrodollar system is unraveling. Saudi Arabia just signed oil deals in yuan. Russia is selling energy in rubles and gold. The world is moving away from the dollar. And when the dollar falls, something has to replace it. Gold will be part of that replacement, but gold is expensive. A single ounce costs over $2,000. That's not practical for everyday transactions. Silver, on the other hand, is perfect. $76 an ounce today, affordable, portable, universally recognized. If the BRICS nations launch a commodity-backed trade currency, silver will be in the basket, and China wants to control as much of that basket as possible before the reset happens. Here's the timeline they're working toward. The BRICS summit in October will introduce a new trade settlement system. It won't replace the dollar overnight, but it will offer an alternative. Countries that are tired of dollar hegemony, think Saudi Arabia, UAE, Iran, Argentina, Egypt, will start using it. Trade flows will shift, demand for dollars will drop, and demand for commodity-backed currencies will rise. When that happens, silver becomes monetary again, not in the official sense, but in the functional sense. And the price will reflect that. Let's talk numbers. If silver returns to its historical monetary role, even partially, the price implications are staggering. In 1980, silver hit $50 an ounce in a pure monetary squeeze. Adjusted for inflation, that's $175 today. But 1980 was a speculative bubble driven by two billionaires. What's happening now is structural. It's about supply. It's about demand. It's about geopolitics. And it's about the end of the dollar system. If silver reprices to reflect its monetary and industrial value combined, we're looking at $200 an ounce, maybe more. And here's the terrifying part for the Western financial system. The suppression of silver prices has been official policy for decades. Central banks don't hold silver reserves. They sold them off in the 90s and 2000s. They leased silver into the market to keep prices low. Why? Because low silver prices support the illusion that fiat currencies are stable. High silver prices signal inflation, currency debasement, loss of confidence. So the Fed, the Bank of England, the ECB, they all wanted silver cheap. They used bullion banks to manage the price through futures manipulation, leasing, and paper market leverage. But now China is breaking that suppression mechanism. By restricting physical exports, they're forcing the paper market to reconcile with physical reality. And the paper market can't win that fight. Because you can print contracts, but you can't print silver. The bullion banks are short. The COMEX is overextended. The ETFs are vulnerable. And China is holding the physical metal. This is checkmate in slow motion. The dollar's dominance has always depended on cheap commodities. Cheap oil, cheap copper, cheap silver, cheap gold. As long as commodities stayed cheap, the dollar looked strong. But commodity prices are breaking out. Oil is volatile. Copper hit record highs. Gold is flirting with 3,000, and now silver is exploding. Every commodity that rises is a vote of no confidence in fiat currency, and China is driving that vote. Let's connect the dots. China restricts silver exports. Physical shortage drives prices higher. Paper market breaks. Silver reprices to reflect scarcity. Industrial users panic. Defense supply chains fracture. Investors flee paper assets for physical metal. Bullion banks default. Confidence in dollar-denominated commodities collapses. BRICS nations launch commodity-backed currency. The dollar loses reserve status. Global monetary system resets. And silver, the forgotten metal, sits at the center of it all. This isn't conspiracy theory. This is game theory. China is playing chess while the West is playing checkers. They've spent 20 years building the infrastructure for a post-dollar world. Belt and Road Initiative, Shanghai Gold Exchange, yuan-denominated oil contracts, digital yuan, and now silver export restrictions. Every move is deliberate. Every move is strategic. And every move is designed to weaken the dollar and strengthen China AS position in the next financial system. Here's what the mainstream won't tell you. The US government knows this is happening. The Treasury knows. The Fed knows. The Pentagon knows. But they can't stop it. Because stopping it would require admitting that the dollar is vulnerable. It would require rebuilding domestic refining capacity, which takes years. It would require stockpiling strategic metals, which is expensive. And it would require confronting China directly, which is risky. So instead, they're doing nothing. They're hoping the problem goes away. But the problem isn't going away, it's getting worse. And the clock is running out. Let's talk about what you should be doing right now. Because hope is not a strategy, and waiting is not an option. First, understand the timeline. The shortage isn't resolving in weeks. It's not resolving in months. China's export restrictions are indefinite. They didn't announce an end date. They didn't offer a phase-in period. This is the new normal until Beijing decides otherwise. And Beijing has no incentive to reverse course. Every day that silver stays restricted, their stockpile becomes more valuable. Every day, the West becomes more dependent. Every day, China's leverage grows. They're not backing down. Second, recognize the cascade. Industrial users are buying now. That drains COMEX inventory. That tightens the physical market. That drives premiums higher. That attracts more retail buyers. That drains more inventory. This is a self-reinforcing cycle. And it accelerates until something breaks. Either prices spike high enough to destroy industrial demand, or the exchanges default and the market resets violently. Neither outcome is good for people holding paper claims. Third, act on physical. If you don't hold it, you don't own it. That's not a slogan. That's physics. ETFs can suspend redemptions. Futures can be cash settled. Unallocated accounts can be frozen. But a silver coin in your hand can be confiscated by a lawyer or a regulator or a panicked institution. Physical metal is the only form of silver that carries zero counterparty risk. And in a shortage, zero counterparty risk is everything. But here's the problem. Physical silver is already hard to find. Dealers are rationing. Mints are sold out. Premiums are at historic highs. If you wait another week, it gets worse. If you wait another month, it might be unavailable at any price. This is not fear-mongering. This is reality. In 2008, during the financial crisis, silver premiums hit $15 over spot, and dealers stopped selling entirely for weeks. We're approaching that level again, except this time, the shortage isn't driven by panic. It's driven by actual supply destruction, and that makes it worse. Here's what smart money is doing. They're buying anything they can get. Eagles, Maples, Krugerrands, bars, rounds, it doesn't matter. They're paying the premium. They're taking delivery. They're storing it securely. And they're not selling because they understand what's coming. They understand that when the paper market breaks, physical silver will be repriced overnight. Not 10% higher, not 20% higher, multiples higher. Because the leverage in the system is enormous and the available supply is tiny. Let's quantify the fear. There are approximately $200 billion worth of paper silver claims in the global market. That includes futures, ETFs, unallocated accounts, and bank liabilities. But there is only about $40 billion worth of physical silver available for delivery in investable forms. That's a 5-to-1 leverage ratio on a good day. On a bad day, when everyone wants physical at once, it's more like 10-to-1 or 20-to-1. Because most of that physical silver is locked in industrial supply chains, jewelry, or long-term storage, it's not available for sale at any price. So what happens when the paper market tries to settle? Simple. It can't. It defaults. And when it defaults, the price discovery mechanism shifts entirely to the physical market. At that point, the price isn't $76. It's whatever the last physical buyer is willing to pay. And in a true shortage, that number is terrifyingly high, because industrial users can't shut down factories. Defense contractors can't halt weapons production. Solar companies can't stop building panels. They need silver, and they'll pay whatever it takes. This is the scenario that keeps central banks awake at night, because if silver breaks, it exposes the fragility of the entire commodity pricing system. And if the commodity pricing system breaks, confidence in fiat currency evaporates. We're talking about a cascading loss of trust. First, in silver markets, then in commodity markets broadly, then in the financial system, then in the dollar itself. China knows this, and they just pushed the first domino. Now let's talk about the psychological warfare. China didn't just restrict silver, they sent a message. The message is, we control what you need. We can turn off the tap whenever we want, and there's nothing you can do about it. That message isn't just for industrial buyers. It's for governments. It's for central banks. It's for anyone who thought the West still ran the global economy. China is demonstrating power, economic power, strategic power, and they're doing it in a way that's impossible to retaliate against. Because they're not invading anyone. They're not firing missiles. They're just enforcing domestic regulations. And the West can't argue with that without looking hypocritical. But the message is also for you, the individual, the saver, the investor, the person who trusted the system, the person who thought their ETF was safe, the person who believed the price on the screen was real. China is telling you the system is fake, the metal is real, and we control the metal. If you don't act on that message, you'll learn the lesson the hard way. Here's the final warning. This is not a trade. This is not a speculation. This is not about making 20% returns. This is about preserving wealth through a monetary transition. The dollar system is ending. It's not ending tomorrow, but it's ending. And when it does, paper assets denominated in dollars will lose value. Stocks, bonds, real estate, they'll all reprice relative to hard assets. Gold will rise, silver will rise, commodities will rise, because they're real, because they can't be printed, because they're the only store of value that survives currency collapse. Silver is the asymmetric bet. It's undervalued relative to gold. It's undervalued relative to industrial demand. It's undervalued relative to its monetary history. And now it's undersupplied because the largest refining hub just went dark. If you're going to position for the next decade, this is the moment. Not 6 months from now. Not when the media finally covers it. Not when your financial advisor recommends it. Now, while you still can. Because the clock is ticking. The shortage is real. The leverage is extreme. And China is patient. They'll wait for the system to break. They'll wait for the defaults. They'll wait for the panic. And when it happens, they'll emerge as the dominant player in the new monetary system. With the metal, with the leverage, with the power. You have a choice. You can ignore this. You can assume the system will hold. You can trust the paper market, or you can act. You can buy physical. You can take delivery. You can position yourself for what's coming. The price is $76 today, but it won't stay there. The question isn't whether silver is going higher. The question is whether you'll move before everyone else realizes what China just did. This is the warning. This is the moment. And this is your last chance to act before the shortage becomes a crisis and the crisis becomes a collapse.